Today, we decided to leave our policy interest rate unchanged.
Federal Reserve Chair Jerome Powell on Wednesday announced that the U.S. Central Bank will keep interest rates steady for now, following a two-day meeting that ended with a unanimous policy statement. But in new economic projections, the Federal Reserve did signal that further rate hikes were likely before the end of this year.
Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized.
The U.S. Central Bank is attempting to rein in inflation, but a stronger than expected economy and job market continues to push prices higher. The Fed's new projections, adding a hawkish tilt to Wednesday's interest rate decision, show policymakers expect rates to raise by about half a percentage point by year's end.
I don't think we have any surprises here today.
Liz Miller is the president of Summit Place Financial Advisors.
By this morning and yesterday, it was pretty clear that the Fed would pause. We were thinking that the current inflation data could have been used to raise rates if the Fed wanted to, but clearly the message was we want to watch more data before we make the next move.
The higher rate outlook coincides with an improved view of the economy, and consequently, slower progress in returning inflation to the central bank's 2% target. The Fed's decision Wednesday snapped a string of 10 consecutive rate hikes delivered, as the central bank last year began scrambling to address soaring inflation.
We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. We do try to be transparent in our reaction function. We're committed to getting inflation down. We're 2.5 years into this, or 2.25 years into this, and forecasters, including Fed forecasters, have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level over 4.5%, far above our target, and not really moving down. We want to see it moving down decisively. That's all. Of course, we are going to get inflation down to 2% over time. We want to do that with the minimum damage we can to the economy, of course, but we have to get inflation down to 2%, and we will. And we just don't see that yet. What we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see. Much sooner than it used to in a world where news was in newspapers and not, the economy is, the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. See housing putting in a bottom and maybe even moving up a little bit. We're watching that situation carefully. In terms of the events of March, as I mentioned earlier, we will be carefully monitoring that situation. Our job generally involves worrying about a lot of things that may go wrong, and that would include the banks. It might be hard for me to identify something that we don't worry about rather than that we do worry about. So we're watching those things very carefully. And as we see things unfold, as we see what's happening with credit conditions and also all the individual banks that are out there, we'll be able to take, to the extent it's appropriate, we can take, if there are macroeconomic implications, we can take that into account in our rate setting.
The CBO projects the federal deficit to be 2.8 trillion in 10 years. The CBO also says that federal debt will be 52 trillion by 2033. At what point do you talk more firmly with lawmakers about fiscal responsibility? Because I'm assuming monetary policy cannot handle alone the inflation or keep that inflation in check with the higher level of spending.
I don't do that. That's really not my job. We hope and expect that other policymakers will respect our independence on monetary policy, and we don't see ourselves as the judges of appropriate fiscal policy. I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Today, the announcement was a pause. There was no rate hike. So I think it met market consensus, but markets are forward looking. So as the Fed starts to give some context, the markets are already thinking about July and beyond. And I think some of what they're thinking is, some of the kind of new news coming out, markets are reacting to immediately, which is, is this going to be a pause with a stop where we have inflation under control, the job is done, or is this a pause with a skip, meaning there's further rate hikes to come because the job is still not done? And I think what we're seeing today is markets are seeing that this is not going to be a pause with a stop. It's going to be a pause with, more hikes to come. So the market reaction is informative. So, a market drop today, and I wouldn't say it's a plunge, it's still pretty flat to me, given where we are year to date at positive 14%. So we know that, the market is reacting to the Fed announcement, and, a downward trend is informative because investors are now refocusing on interest rates rather than this AI frenzy that's been pushing the markets and tech stocks up and up. So I think, people are now thinking about, what does a higher interest rate, look like, or what does kind of a more persistent inflationary world look like? And is that realistic to think that equity markets should continue to go up that strongly, as well as, what are the impact for tech stocks in general?